Hello, I'm Mark Dunn, the editor of investment magazine Portfolio Institutional. We focus on how pension schemes, insurers and charitable foundations invest their cash. And welcome to what is the third and final video in this series, which looks at how index investing in the bond market has evolved. And this particular discussion looks at how indexing is influencing the derivatives market. And as usual, I'm joined by people who know a lot more about this subject than me. And for those of you who've already seen the first video, you will recognise one of our panellists. So hello again, Natasha.
Hello, hi.
Now, for the viewers who haven't seen the first video yet, could you just give us a reminder of who you are?
Absolutely. So my name is Natasha Blackman. I work at BlackRock in the iShares fixed income ETF product strategy team.
Great news. Thank you very much. Good to have you back, Natasha. And Shri, could you introduce yourself, please?
Thanks, Mark. My name is Shri, and I work in iShares market index team in the tradable fixed income and credit index products focused on Europe and Asia.
Thank you very much. All good. Natasha, if we could start with you, what role have fixed income ETFs played in modernising Europe's bond markets?
Absolutely. Well, much of the early investment into electronification really came from ETF market makers, authorized participants, or APs as we call them, who sought to gain efficiencies in their own workflow. So for example, growing demand for broker-dealers and APs to rapidly price and trade portfolios of bonds to facilitate fixed income ETF creation and redemption. That led to the rise of algorithmic bond pricing and accelerated the adoption of electronic trading, as well as alternative bond trading architecture. In addition to developing these algos and other sophisticated trading infrastructure, market makers have also adjusted their internal setups so that ETF trading is now much more integrated with macro and single line bond trading desks. And more recently, ETF-related infrastructure is being used to facilitate not only ETF trading, but also electronic portfolio trading by trading platforms. And in turn, these ecosystem developments are leading to further efficiency improvements and trading transparency. And in this way, contrary to initial concerns, the rise of fixed income ETFs have actually helped to enhance underlying bond market breadth and liquidity, and really driven the modernization of European bond markets.
Thank you very much for that, Natasha. And Shri, how has market efficiency in the bond market evolved in recent years, and what role has indexing played in that?
Sure, Mark. So the ETFs have certainly played a large part in the evolution of credit market infrastructure, which now includes a range of credit index products. ETFs' strong liquidity and ease of access enable it to incorporate and reflect market information much faster than the underlying bonds, a feature which is also appreciated by central banks when bonds were distressed during the COVID-19 sell-off. Indexing, coupled with transparent underlying bond pricing and multi-dealer activity, has become an important part of investors' approach to portfolio construction and risk management today. Tradable instruments that reference fixed income indices, such as the fixed income ETFs, and standardized index derivatives, such as the standardized iBoxx TRS and CDS indices, bring transparency and trade efficiency to an otherwise often opaque and fragmented bond market. In the derivative space, there's also been a clear trend to reduce risk by moving more OTC products to a clearing framework and to facilitate trading on SEFs and MTFs. These developments have allowed credit index products to flourish and provide investors with multiple options to efficiently express views on the underlying markets.
Thank you very much, Shri. And Natasha, we've heard that the fixed income ETFs have been driven by technology, infrastructure, electrification of the bond markets. But what role do you see them playing in the future, now the next 10 years?
Sure. So we expect to see continued growth in adoption of ETFs by an ever more diversified investor base, and further utilization of fixed income ETFs as financial instruments, both on the long and the short side. Fixed income ETFs, and especially corporate bond ETFs, have really become a sort of reference instrument of choice for many market participants for returns, volatility, and market sentiment. And over time, we expect the largest and most liquid fixed income ETFs really to become a go-to risk transfer tool of choice and compete directly with iTraxx CDS indices. Developments such as larger lending pools, bank repo desks starting to trade fixed income ETFs, and the increased activity and options on ETFs will further improve liquidity, while new tools and analytics are already helping investors to analyze fixed income ETFs alongside other instruments. Now, aside from using ETFs as financial instruments, they're also increasingly being used for ESG integration in portfolios by a broad range of investors, including institutional. And indeed, many of the core exposures where European investors are active already, they actually mostly exist today in a sustainable format. So, AUM in those funds are growing very quickly, and over time, we would expect sustainable ETFs to overtake the largest traditional market cap exposures, both in terms of size and liquidity.
Thanks for that, Natasha. And Shri, what role do you see them playing in the next 10 years?
Yeah, so we believe the ETFs will continue to grow as the instruments that allow investors to efficiently gain market exposure. And as an index provider, we look to support the developments in the fixed income market structure by making sure the indices underlying tradable products, such as the IHYG, remain not only representative, but also executable in the market. Certain benchmarks are also specifically designed for risk premium strategies, which can be accessed through the ETFs. For instance, the iBoxx Euro Liquid IG Ultra Short Index tracks the liquid investment grade bonds that have a low duration profile, defined as bonds with maturity of less than 3 years. This index underlies the iShares ERNE ETF, thereby giving investors a way to invest in portions of the credit market that have historically been less volatile and less exposed to interest rate risk. And of course, as Natasha also mentioned, ESG and sustainable investing is a fast-growing area in recent years, and we certainly expect ETFs to be at the forefront of this. From an index perspective, we've launched a number of initiatives in this space already, such as the iBoxx ESG Ultra Short Indices, which are tracked by the iShares ESG Ultra Short ETFs, and credit default swap indices, such as the iTraxx MSCI ESG Screened Europe Index. We believe that further innovative ESG-based indices and ETFs are certainly an exciting area to look out for in the coming years.
Thank you, Shri. Thank you. And Natasha, could you give us some examples of how investors are using fixed income ETFs as an alternative to fixed income derivatives?
Sure. So investors, institutional investors who have traditionally used CDS indices for things like tactical trades or liquidity sleeves are now increasingly considering and choosing ETFs instead. So when you look at the two instruments, clearly the risks associated with the products are very different. But the fact that the ETF track broad market indices mean that investors are getting more diversified exposure, and that in turn closely tracks the broader cash markets, relative to CDS indices. And given the significant improvement in liquidity in ETFs over the past few years, as we can see through higher trading volumes and tighter bid-ask spreads, as well as the broader ecosystem developments in Europe, all of these things combined really mean that ETFs and their derivatives are increasingly seen as viable alternatives to CDS indices, which really is the traditional reference instrument for credit.
Thank you very much for that, Natasha. If you could stay with you, how do you believe the fixed income ETF options market will develop in Europe?
Sure. Well, it's been encouraging to see activity increase in this market over the past year or so. The development of the lending market in Europe has helped support liquidity here. We're seeing activity from institutional investors across different exposures, especially in dollar credit. And in terms of future growth, we really believe that the US market provides a bit of a blueprint here, and we expect to see further growth in Europe over coming years. In the US, option open interest for fixed income ETFs has grown exponentially, fueled by growth in fund AUM, secondary market trading, and ETF lending activity.
Thank you, Natasha. And Shri, I saw you nodding along there. What do you think about the future of the options market in Europe?
Sure. So the ETFs are great tactical tools due to their ease of use and the fact that they provide diversified exposure to the market in one trade, essentially. Due to the ability to trade ETFs quickly and efficiently, they're well suited to express tactical views that deviate from an investor's overall strategic allocation, which is typically done with bespoke derivatives earlier. The increased use of ETFs has actually been accretive to the overall fixed income and credit markets. The sharp rise in ETF volumes has taken place concurrent with increased activity in the broad spectrum of credit products such as total return swaps and CDS indices. For instance, while ETFs were one of the most liquidly traded credit instruments in 2020, the CDS indices also reported record volumes that year, indicating the complementary features of the two instruments. The instruments all have their unique characteristics. The ETFs are funded cash instruments that come with the ease of access to the underlying bond market. The total return swaps provide zero tracking error, and iTraxx and CDX offer pure credit play. And this diversity in the market ecosystem enables for more efficient hedging across instruments and also act as tools suited for specific use cases.
And Shri, how do you believe the fixed income ETF options market will develop in Europe?
Sure. So in the US, the fixed income ETF options have gained considerable interest from market participants to express views on or hedge volatility in the underlying markets. The fixed income ETF options complement the CDX options in that they allow investors to take positions on rates and credit volatility versus pure credit volatility. And similar to other credit index instruments, we believe the fixed income ETF options and CDX options enhance the investor's toolkit to gain exposure to or manage risk. In Europe, the iTraxx options are already liquidly traded instruments with about 2 trillion notional traded in 2020. So the demand is clearly there. And similar to the US market, the fixed income ETF options on liquid ETFs such as the IHYG could complement the iTraxx options in Europe and act as a useful tool to manage credit risk portfolios.
Okay, thank you very much there, guys. We spoke briefly, but we did cover a lot. It does seem to me that ETFs are going to be on a long time in the fixed income market, especially in Europe. So thank you very much for your time and for sharing your thoughts with us. Natasha, thank you. And Shri, thank you. Hope to catch up with you again soon.
Thank you
Thanks
so much.
Thanks, Natasha.
Goodbye.